Hey, I just want to talk real quick as to this SCO trade that we did yesterday. SCO today is trading down 21%. It's at 42 right now. We shorted a call yesterday when it was 62, 63, and then took an $800 profit in like an hour when the SCO came back down. The implied volatility when we sold it was 900%. And when we bought it back an hour later, it was like 600% implied vol. So we made money both because of direction and volatility. But what I wanted to do was just show you this website from ProShares. A few people were asking overnight, like, why are the options so expensive? And it seems like you're getting free money here. And all these leveraged products, all of them, are designed in a way to basically meet a daily return of the underlying product. So let me try to explain to you just in a minute here what's really happening with these leveraged products. They do daily rebalancing. So if you read this here, okay, and the daily rebalancing and the compounding of each day's return over time means that the return of each fund for a period longer than a single day will be the result of each day's returns compounded over the period, which will very likely differ from 2 times or 2 times the inverse of the return if, of the fund's benchmark for the same period. Now, SCO is 2 times the inverse of the oil index, and then they refer to oil futures. Now, what they're telling you is that they will try to achieve the results in a single day, but not longer term. Okay? And then what they tell you is a fund will lose money if its benchmark's performance is flat over time. So what does that mean? So in what scenario do you lose money if the market is flat? So think about the option market. When the market goes nowhere, if you own calls and you own puts, they slowly over time decay and then approach zero. So what this means is that without knowing what's in the product itself, its ability to replicate the daily performance means basically that from the opening to the close, they put on trades to replicate double the move by using leverage. In other words, they're buying calls and they're buying puts. Now, over a day, the time decay can be small, but what happens is they rebalance every day, which means they're loading up on lots of long calls and lots of long puts. And with that decay that happens, longer term, they will underperform the market because they're basically long options. So what they're telling you is that a fund will lose money if its benchmark's performance is flat over time. Now, they're not saying flat over a day, and here's the trick. What they're telling you is they'll match 1 day's return by using options, but they're telling you that over the long run, they will not be able to match the index. So what they're doing is they're buying lots of options, and if you were to hold this product, it would be the equivalent of holding lots of daily options. And if you were to do that, you're almost guaranteed to lose money. So the problem here is a lot of people think of these products like SCO, all these leverage products, VXX. They all think of these products as products that can be held long term, and that's wrong. These things will lose money over time unless you have a huge move. And so you shouldn't be using these products. And it says here, and a fund can lose money regardless of the performance of its benchmark as a result of daily rebalancing. What this means is they're telling you up front, because the SEC requires them to be transparent, is that they'll try to maintain the performance for a day, but every night they're going to go in and make adjustments. And when they come in the next day, they're going to be charging you management fees and other expenses, and then they're going to be selling options for a loss, and then they're going to buy some other options for the next morning. And this is over time is going to guarantee you're going to lose money. So they're telling you, A fund can lose money regardless of the performance of its benchmark as a result of daily rebalancing, the benchmark's volatility, compounding, and other factors. What they're really telling you is the compounding of the daily losses that they're going to do after the market closes and putting on all types of different types of leveraged products to try to replicate the performance the following day almost guarantees that over the long run this thing is going to lose value. Now occasionally the market's going to spike up and it's going to basically double in value from time to time, but over the long run this product is going to constantly be doing reverse splits. And if you want to really understand what's happening with these products, all you need to do is go pull up a 10-year chart of the product and look and see where the price was 10 years ago versus today. And what you're going to find out is that these things just slowly drift towards zero. And when they normally approach around 10, they do a reverse split like 10 to 1 or 5 to 1, and immediately it's back up to 50 to 100, and then the process starts all over again. You do not buy these things long term. Okay, you're guaranteed to lose money. You can read the prospectus, okay, and this is where I found this. This is in the prospectus. So if you want to read this document, okay, look at the index here, 121 pages. Okay, they do swap agreements. Okay, they use futures, they use options, they use OTC products. Okay, these are all products that have no mark to market. They can basically buy and sell them for whatever they want. And they're going to be buying and selling them from people who they have relationships with. And the person who's going to end up losing out on this is going to be the people who are buying these products long term. So 121 page prospectus on what this thing is. So I've just saved you the effort of having to read it. Just, do not buy these types of products for more than a few hours. And if you're only buying them for a few hours, then you're gambling. And you shouldn't be gambling in the market. Okay, and these are the products in their prospectus that they're actually covering in one document. So all these types of products, okay, you should not be trading these ever. Okay, thanks.